Let me introduce Tony. So Tony Rose is the founding partner of Rose, Snyder, and Jacobs. His client responsibilities include, but not limited to, tax and management consulting, advice to closely held corporations, family-owned businesses, partnerships, and the high net worth individuals who own them. Tony is the author of 5 Eyes on the Fence, protecting the 5 core capitals of your business, and say hello to the elephants. Please help me welcome Tony. Tony, welcome.
Walter, how are you? Nice to see you.
I'm great. You're coming right after health and wellness, and you look amazing. So you obviously subscribe to that.
I put on a tie for you guys today. So what can I say? It's the first tie I've had to wear for a long time.
Nice. Talk to me about the 5 core capitals of your book. Let's start there.
It's actually very interesting, and it ties in very well to family office planning, because several years ago, I was reading a book called Keeping It in the Family by Jay Hughes, where it talks about creating a family's balance sheet. And I thought to myself, how do you measure a family's balance sheet? He talked about something called human capital, but it didn't satisfy me. I'm an accountant. I'm not an attorney. Actually, I'm a CPA, and I think in terms of counting. And so I said, how do you count what a family owns? And I determined that they own actually 5 different things. The first thing they own is themselves, their human capital. The second thing they own is the financial capital that they own. That's obvious. The third thing they own is the intellectual capital, the things that they know. The fourth thing they own is the social capital, who they know, who's in their lives. And the fifth thing they know is how they do things, how they go about doing things as a family. That same thing applies to a business as well. And so I talk about in my book, 5 Eyes on the Fence, how do you measure that, and what are the important elements of those 5 different capitals?
Amazing. What in your tax practice? Let's digress a second and just talk about kind of basic tax, and then we'll start talking about some family planning. What do we always want to know? We always want to pay less tax. That's always the thread of most people. How do I do that?
Well, yeah, it's really interesting, and because 30 or more years ago, really paying less tax often was a big thing. You spend a little money, and then you get a big tax deduction, and you could say your rate of return happened by the tax investment itself. And that no longer is the case in my experience. In my experience, what we want to do is earn money and wrap some kind of tax protection around it. So that could mean buying something that's going to appreciate. That could mean buying something that creates tax protected income, like a tax-free bond, something as simple as that. There's a number of techniques that sort of whittles away at your tax bill. You can be too cute sometimes and get yourself into very sophisticated transactions that you're not prepared to follow through on. Now, that doesn't mean that there shouldn't be some sophisticated transactions. And if you have a good group of advisors around you that can help you navigate those very dangerous waters, then maybe you go ahead and do it. But it's a question of risk tolerance, and it's a question of how much you want to spend in trying to educate yourself on the ins and outs of the particular tax investment.
It's an amazing point, and I don't know that people equate to risk management in the same sentence as tax. They talk about risk management with investments all the time. That's standard. Everybody knows that They look at an investment and they say, is that risky or is that safe? But you bring up a great point. Can you just kind of elaborate on just more on the risk side of tax? You've been at this a really long time.
Sure, sure. You can, one way to mitigate tax risk is to just pay too much taxes. That's no fun. That's probably not necessary. But there are a group of people that for that it works. Just pay your taxes. Don't ask a question. Don't try to do anything tax-wise. And if that fits your temperament and style, I don't think that's a dumb thing to do. In fact, the only stupid thing to do in taxes is to do something that's uninformed or do something because somebody else told you to. Having said that, there are tax risks to certain things. For example, the current cause célèbre for the IRS now is captive insurance.
The what? What did captive insurance?
Walter?
Captive insurance?
Yes, captive insurance.
Okay.
And now, captive insurance is baked into the code. The ability to have create your own insurance company where in effect you self-insure, but through the framework of the tax code is in the code. It's okay, but the IRS doesn't like it. And over a period of many years, they've attacked and attacked and attacked. And over the last couple years, they've actually won a few cases. Now, you can argue about judicial legislation and all that sort of thing, but the fact is that the IRS won on some situations where the captive insurance was done completely right. And the judge said, well, I don't care. It was done completely right, but it was really done to avoid tax. And we're not going to sanction that. We're not going to allow it. So now the IRS, early this year, just before COVID, sent letters to everyone that reported captive insurance and said, we'll let you settle. And if you will allow, I think it was like 20%, something like that, of your tax deduction, but you have to agree to pay all this tax money back and then we'll leave you alone. And those letters went out to everyone just before everything shut down. They were originally due May 4th, and I think now they became due at the end of May. And people that had captive insurance companies had to respond or felt they had to respond. Actually, you didn't have to respond. All of our clients actually did. So the IRS will get on the warpath on some things. Another thing the IRS is on the warpath on right now is something called conservation easements. And so your tax advisor, I'm not telling you not to do these things, but what you need to do is have your tax advisors inform you about the relative tax risks of any approach. And that way you can be informed and move purposefully through the code, which is getting more and more and more complicated.
Yeah, and I guess that dovetails. You bring up two areas, captive insurance and conservation easements. Somebody goes to a professional, and these all sound so good when they're being discussed from somebody that's trying to sell you something. What advice do you give? Because that's really what this summit is all about. It's just to be neutral and give people the awareness to ask better questions. So in tax planning, what are some better questions that individuals would want to ask when they get presented with these opportunities, I'll call them opportunities, in a manner that they look so good?
I think that if you're an individual of wealth, you need an advocate on your side of the table. So if someone comes to you selling a particular product, I call it a solution looking for a problem. I think you want to have someone listening with you to what they're proposing. These may be very, very good suggestions, terrific suggestions. But if you don't have someone who's compensated based upon your success and your happiness on a long-term basis, then the filter by which information is going to come out to you is going to be too advocative for a certain product and not for the most important thing, which is you. So you want to have a good attorney, a good accountant, good insurance agent, a good investment advisor who really is tethered to you and your happiness and your financial well-being. And again, I'm not taking away from salespeople, but people that are hawking a product to you are salespeople, and they are trying to influence your behavior and your decision. Again, it might be totally appropriate for you to do that particular thing, but you need someone who's going to be sitting back and saying, okay, I know who you are. I know what you want. I know what your aspirations are. I know what your risk tolerance is. That's my advice.
Well, it's interesting. What you're advocating is very consistent with what we talk about, because typically the money is not going to have the level of depth and expertise in these very specific areas. And so we kind of call it, you walk into the auto repair shop and you bring a mechanic with you. And so you tend to get better service and better advice. Let's kind of segue. So, obviously, as a tax guy, you also deal in family planning as well, and business owner planning. So, hey, we can't get around the environment that we're in COVID, and what's happening in your world today, and what do people want to be thinking about in terms of planning from your perspective?
That's a great question right now. There has never been a better time to think about wealth planning and tax minimization than right now. And it's kind of hard for people to focus on it. No matter what your politics are, though, there is a potential of a change of administration, which means that after the election this year, things may change. And we know what things are now. And since things are not likely to happen retroactively, which means that after something done during this year is not likely to be reversed for tax by any legislation that happens in 2021, transfer planning now is a great thing to do. That is because there's a combination of a couple factors. First, the lifetime exemption per person is $11,400,000. That's an awful lot of wealth that can be transferred intergenerationally without there being any transfer tax. We call transfer tax, estate taxes, and gift taxes leakage. It's leakage in the family unit. So if we think about a family as a whole, all the assets, if they stay within the family, is a great thing. To the extent that you're paying transfer taxes, there's leakage. So there's that one factor, $11,400,000. The second is that the ability to transfer businesses and real estate now is enhanced by the depressed economic times that we're in, because things are worth less now. And if when the economy, because it always comes back eventually, begins to boom again, values of things will be enhanced. So real estate now is likely to be depressed. Business valuations are likely to be depressed. So that's the second thing, $11,400,000 a piece, valuations. And the third thing is the opportunity to use discount planning. When you give a fraction of an asset to somebody, it's not worth the same as giving the whole asset to someone. That's discounts. There's two major kinds of discounts: minority interest discounts and marketability discounts. The ability to use those discounts in certain situations in a family is likely to be tightened in the future, but it's not now. It is still an area of tax risk and dispute. There's a recent case that just came out about something called formula gifts, where the taxpayer lost, and the whole tax community has been stunned by it. But those are three elements that are happening now. And if you delay doing something in 2020, they may not be available to you in 2021. So we're recommending people think about this.
Are you making any political statements here, Tony, about who you think
No.
is going to win in November?
No, I'm not. I'm not, because it is possible, no matter what party wins,
Yeah.
because of the deficits, there could be changes in the tax law. The 2017 Tax Act, which President Trump discussed as a tax reduction, was not a tax reduction for many families. And yes, I was thinking, as I did my own taxes this year, that I've got to have a stiff upper lip. But I paid more taxes this year than I would have paid before the 2017 Act. And it is possible to raise more money in the government. They're going to take more from wealthy families, because the deficits are ultimately untenable.
Yeah, and something.
That is a political statement, I guess.
No, I get it. And one of the things you talk about, these very interesting things, and people get very excited, like, oh God, I gotta go do something. But one of the things I'd like you to speak to is in planning mistakes, it's vital that you first take care of the family, kind of mom and dad. So talk about that order, that being the primary, and then all this moving around and discounts and things like that.
Oh, sure. You know, Walter, I don't know whether you and I have talked about this in the past, but you really start with the first foundational concept in doing any kind of transfer planning. That foundational concept is no one does current life transfers unless they believe they have more than enough. I'm going to repeat that again. Even though the idea of transfer, the 11,400,000 in discounts and all that stuff, is a smart idea, if you are not sure that you have enough, you're not going to do anything. And that makes perfect sense. Why would you?
Yeah, because you can get into scenarios where you have a very wealthy family that spends a lot of money. They got multiple homes. They travel on private planes, so their spending is very significant. So they're above these thresholds, which, you know, these $11 million thresholds. So elaborate on that.
Okay, and before we do that, Walter, I'd like to say that even if you're below a $11 million threshold, you may want to plan now to make sure the disposition of your assets are what you intend them to be now. You don't have to do things that are irrevocable, but you should, every several years, certainly every 5 years for sure, look at what you have set up for your living trust and your healthcare directives and all that kind of stuff, and make sure that they're freshened up. It's money well spent, even with less than 11,400,000. Now, in fact, and I want to, there was a time when everyone was doing something called spousal trust, which in effect is the husband owns, put into trust for the benefit of the wife, assets, and the wife, the vice versa for the husband. And that works very well in community property states. But it is very possible that where you have inherited wealth on one side of a couple, that the one party is putting into trust all their assets that they inherited, that actually the wife ends up controlling without you knowing it, and then the wife puts much less assets that are in the control of the case I'm thinking about happened to be a husband and wife, where the husband had a lot of inherited wealth and actually put it in a spousal trust, which was great estate planning, but he finds out that the wife now is in control of the assets. So when you're doing this kind of sophisticated planning, you need to make sure that you're talking to your professionals about all the ramifications of all the smart stuff you do. Some of that planning that you do is irrevocable. You cannot take it back. That's why you start with, you got to know what's enough for you. We have one client, if I can go on, Walter, that is worth about $200 million. And it is a family. And the question was, how much can I give away now? How much of that 200? No one really needs to have $200 million. Even if you spend a lot of money, you don't need it, at least in the way I live. But maybe the way they live, they needed the whole $200 million. So we said, how do you calculate? Let's calculate what you need. And we did that by saying, okay, let's figure out what you're actually spending every year on a normal year, including contributions, vacations, gifts to the kids, gifts to the grandchildren, helping to pay for private schools, whatever you do, paying your housekeepers, if you have any, all that stuff. Let's figure out what that cash burn is. How much are you spending in cash on an annual basis? And how much do you need for padding? So you figure out what that after-tax burn is, because you don't think about the taxes that you spend. You know, you could be making $1 million. You could end up having $500,000 of taxes. So all you have to spend is $500,000, not $1 million. $500,000 is a lot, but it's a lot less than $1 million. So what we do is we do this calculation where we look at cash burn. We look at how much pre-tax income a family needs to have to burn that on an annual basis. And then we multiply that times a certain factor to determine how much assets have to be really, really safe and secure so that you can do other things with those assets, either a long-term investment, a risky investment, or giving it away to your children or grandchildren. And we do this calculation. Again, you don't do this alone, or most people don't do it alone. They need to have smart people around them that can help them engage in that process.
I kind of want to ask, I mean, what was the number?
Well, for this family and for each side of the family, we determined we wanted to put $20 million on ice for each of the family members that controlled portions of the wealth, so that they would, on an annual basis, be able to have, for 5 to 7 years, if they had to hunker down, enough money to live on. And most of the other assets are going into much longer term investments that are not easily liquefiable. But if you can wait economic dislocation out, it will be okay. So for this particular family, it was $20 million. So there was two main parts of the family, so that's $40 million. That means they could do stuff with $160 million of other stuff and feel absolutely confident. The worst thing you could do, we only had one client in March when the market fell that dumped out of all their stocks. We thought that was not a smart idea. We advised against it. And that person now has experienced a permanent declination of their assets because they got scared. See, you end up doing stupid stuff when you're scared.
Yeah, let me segue. I love what you just described is exactly what Bobby Kaufman, he was a planner that was on week 2. The numbers were just different. Your numbers were bigger, his numbers were smaller, but he talked about the psychological comfort factor of distribution. And you said it just almost verbatim, so love it. But let's, in the few minutes that we have, with COVID, let's address, because we're all super healthy, but then this pandemic comes around and there's a big unknown around, healthcare powers, directives. Kind of just speak to that a little bit about how to get your affairs in order. We know that if one of your kids comes down and you know they're 19 years old and you don't have access and power of attorney, and a lot of times kind of speak to that, this world of HIPAA and healthcare issues.
Okay, and again, this is kind of a legal thing, so I'm really talking kind of as an accountant counselor.
Yeah.
I think you know this, Walter, that my 28-year-old son died one night in his sleep. And it was a terrible thing. But he had no estate plan. He had nothing because he was never going to die, and he died. And it was a natural freak thing. And so, but you know what? You suggest something that's very important. The parents need to have healthcare directives, and there should be something in writing that the parents write for their children or whoever is going to be making their healthcare decisions. Not discussing this because it's very hard to discuss, incredibly hard to discuss. But you got to discuss what happens if you get ill and what you want to have happen, and things called DNRs, do not resuscitate orders, things like that. The last thing you want to do is be kept alive mechanically when your quality of life is not good. But there is no doctor in the world without someone responsible telling them to pull the plug that's going to pull the plug. And the healthcare directive for the parent is very important. And your attorneys are going to be able to help you with that. Your counselors, which may be your attorney, maybe accountant, maybe an investment advisor, might help you talk through what your options are. But there actually should be healthcare directives for your children as well, because there is, and you know, a 19-year-old, that might be hard, but a 29-year-old, maybe we should have, or a 28-year-old, maybe we should have discussed that with John about what happened if he got sick and what he would want to have happen. It is excruciatingly difficult during a crisis to pull a plug or to do any kind of a rational thing because you're in the moment, and you should be in the moment. Having this kind of pre-planning permits you to take what you've memorialized and reread it and remind yourself. Even though you're emotional, you can remember what you were thinking about when you were thinking about it as being a distant contingency.
What's your recommendation, just as, you know, your parting thought here as we wrap up? But that's a great, how do you, in your time in the business, how do you advise the family to have this kind of challenging discussion?
Sometimes you need a mediator. Sometimes you need to have someone who's a professional in the room that can be really sensitive. In fact, a lot of the time, because this will dredge up all kinds of stuff in the families. And so having a counselor at the table talking about this stuff and helping to proctor this discussion is good. The other thing is that you got to say it. You got to talk. If you don't talk, there's so much left unsaid. If you do not communicate your estate plan to your kids or your other heirs about what your intentions are, you never give them an opportunity to ask a question, to voice an objection while you're alive. And that what will happen is if they have objections and you're dead, they'll take it out on the other heirs. And that creates family disharmony. So what you need to do is talk. If you need someone to help you to talk, have someone there to help you do it. But talk. And it will be difficult and it will be sloppy and there might be some hurt feelings. But if you do it out of love and out of sincerity, I think what you're going to find is you'll get a much better result.
Wow, Tony, that was great. Thank you so much for your time, throwing on a tie. Absolutely love it. It's been great getting to know you. And again, sorry for your loss of your son.
Sure.
And Thanks for being here and vulnerable and telling us like it is. Thank you.
Thank you for having me.